Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate investment expert, Ken Gee. Now, Ken is the founder and managing partner of KRI Partners and the KRI Group of Companies, a real estate investment group that specializes in multifamily investments. Ken has more than 24 years of real estate, banking, private equity, transaction, and principal investing experience. Throughout his career, he has been involved in transactions valued in excess of $2 billion, much of which has included the acquisition, management, and financing of various multifamily real estate projects, as well as playing a significant role as a member of the due diligence and transaction structure planning teams for several private equity firms specializing in small and middle markets. And so, guys, with that, it's my honor to welcome my guest for today's show, Ken Gee. Ken, how you doing today?
I'm doing great. Thanks so much for having me.
Yeah, excited to have you here. And as we were talking about before we started recording, you are based up in Cleveland, Ohio. Is that correct?
We are. Yep.
All right, excited. But most of your assets are down in the Florida area, all across Florida, it looks like. And so excited to chat with you about that. Excited to dive into your business, exactly, how you built it and where you guys are at today, what you're focusing on. But before we do that, Ken, I'd like to take a few minutes, maybe pass the mic back to you and ask that you take, some time and tell us a little bit more about yourself, your background, and ultimately how you found your way into the multifamily sector.
Yeah, that's a great question. So I grew up in Toledo, Ohio, excuse me, and got my undergraduate from University of Toledo, then moved to Cleveland. Got my when I moved to Cleveland, I became a commercial lender, spent 5 years as a commercial lender while going to Case Western Reserve University, got my master's from there, and made the switch to public accounting, where I worked for Deloitte for 7 years on the tax side, doing a lot of private equity M&A work, a lot of fun stuff, but a lot of hard work. All during that time, whether I was a lender, whether I was a CPA, all I kept hearing from my clients and my customers was real estate, real estate, real estate. They were making a killing, and I was working really, really hard for them, and they were really killing it. So it was 1990, well, actually 95, 96. I started, I got to do this. I got to get this done. So in 1997, we bought our first asset in a small part of Cleveland called Shaker Square, and then the rest is history. About 10 or 15 years later, so we kept accumulating some assets in the Cleveland market. 10 or 15 years after that, I said, you know what? We're doing okay in a non-growth market like Cleveland. We need to go put our stake in the ground in Florida. And so we started that process. And here we are today. We take care of about 2,000 units throughout central and northern Florida. And it's probably, in the Southeast is probably where we'll spend most of our time going forward.
Fantastic. And what year was that when you actually planted that stake here down here in Florida?
Yeah, it started back in the mid 2000s. We actually planted our first stake in 2014 or 15. I don't remember exactly what it was, but we saw the ramp up to the first recession, the Great Recession. Saw that we just couldn't find something that made sense back then. People were buying for very different reasons, and it wasn't so they could operate them as apartments. And so we kind of waited that out. Personally, I went through a divorce during that time, so we kind of waited that out. And then and then came back full force after the recession.
Okay, fantastic. And I'm assuming that over a few years you decided to exit out of your assets up in Ohio. Are you completely dissolved of all the assets that you owned in the Ohio marketplace?
Yeah, good question. I did leave that out. Yes, absolutely. We liquidated everything in Ohio, and now we're exclusively in the Southeast.
Okay, very exciting. And so I want to back up a little bit about the transitionary period from when you were working full-time, working your 9 to 5, and you started buying some assets personally, and then ultimately you made the decision, took a leap of faith, and actually went full-time into real estate investing. When did that happen, and how does that transition occur? I mean, was it just cold turkey, or was it over a period of years that you made that transition?
Yeah, that's a good question. So I wouldn't call it cold turkey. So I bought my first asset while I was still at Deloitte.
Okay.
And think about Deloitte's one of the big firms. So, I was working 70, 80, 90 hours a week. And my first asset had to be a 28-unit building so we could afford to have somebody taking care of business on site while I was, busy being a CPA. So I slowly just started accumulating assets over a period of time. And it wasn't until, I'm trying to think, it was 2001 when I finally made the permanent switch. I quit my job at Deloitte. At the time I was a tax manager, And then, well, actually at the time I bought 3 Cessna pilot centers right before 9/11, taught me a whole lot about running a company during a very difficult time. 3 years later, we had grown them to be, it was actually initially 1 location, a bunch of old airplanes. When we sold it, we had 3 locations, all brand new Cessna aircraft. And we also sold some aircraft as well. But I exited that business about 3 years later. And all during that time, I was making that transition to real estate. And now it's all we've done ever since then.
Got it. And in the multifamily world, what type of assets are you guys going after? I mean, what typical vintage are you looking for, size, things of that nature?
Yep, it's always BC class assets.
Okay.
And we're looking for value add deals, probably like most people are. And we like to be in the plus or minus 100 unit range. It's because most people aren't looking in that size range. Mm-hmm. We just raised our first blind pool fund. So almost no fund managers are looking at that size property. So, I feel like that gives us a little bit of an advantage on the buy side. Most people looking in that size are syndicators. Mm-hmm. So they need to try to find a way to tie it up, then go raise the money. And then when we go approach sellers, we got the money already raised. As you know, that's how a blind pool works. And then we're a much stronger buyer in a very competitive market.
Absolutely. I think the importance, what I tell everyone with a fund, the importance of a fund is just ensuring that you actually have the deal flow to support it, right? You got to be able to actually deploy that capital that you've brought in a reasonable amount of time and actually deploy it, not haphazardly, but very diligently in quality assets, and not be forced to buy, the less desirable properties, which we've all seen in the past, right? When someone's forced to buy something, they put the money to work, they, make poor decisions. And so I wanted to actually speak to that a little bit. I had this conversation the other day with Ken McElroy from Rich Dad Advisors, had him on the show. It was a fun conversation. And we were talking about, some of the big shifts that they've made in their company over the last couple of decades, different markets that they now focus in, which, in other markets that they've, pulled away from. And, but really where the conversation landed was being able to truly separate the, he called them the turds, right? The turds from the winners, right? And so we look at properties, and very rarely, if ever, does a property truly match the pro forma that we've laid out, right? It either exceeds expectations or it does not meet expectations, but it never lands directly on the spot of what we thought it was going to do. And lots of times we're surprised, some of the ones that we thought would just be steady performers, they end up, just kicking butt. And then other ones that we thought would have done better, don't necessarily, excite us a year or two down the road. And it might be okay, but they haven't really met our formal expectations. And so with that being said, what do you guys do internally when you're looking at assets? How do you identify and hopefully, steer clear of the turds, the ones that, again, just are truly going to miss expectations entirely? What is something unique that you guys might do to avoid those?
Yeah, I don't know that we're necessarily unique. I can tell you what we do. And that is we really start from a macro level and work our way down, because you have to do that. So we always start with neighborhood and market and economic drivers. We're really big on that, because the good neighborhoods, even in downtimes, they tend to do far better than the tougher neighborhoods, because it's just the way it is. Tougher neighborhoods, generally lower income. Those people are more affected normally by economic downturns. So we always start with neighborhood. And then we do a lot of on the ground homework. So once we identify a market or a neighborhood that we like, or what really happens is something comes available. When we decide whether or not we want to look seriously at that asset, we start with the neighborhood and work our way down. So we're looking for the same things most people are: median income, job growth, things like that. But what's really important is that we do our homework in a very detailed way about where our property is now, where the particular property we're looking at, where is it now fit in the market in terms of rent stack, and what can we do to make that improvement, to move it in the rent stack, and what will it look like? And we literally stack them up. We do a very detailed analysis here to try to figure. I usually am able to put markets or little neighborhoods into tiers. I have a top tier, a middle tier, and a bottom tier. And what we typically find that we do best at is moving something from the bottom of the second tier and moving that up at least half a tier. And oftentimes what's happening right now a lot is we have huge gaps in the market, especially in Florida. We have a lot of people have kept up with price increases, rental increases. A lot of people haven't. And so what we find are pretty good assets competing with that lower tier asset when they shouldn't be. And so we're finding a lot of those opportunities where we're able to come in, add our value, and fill this gap very, very successfully. So that homework is what I think really helps us separate the turds from the good ones, so to speak. But it's that homework, right? It's literally getting in, drilling, Google driving, then getting in your car and visiting the leasing offices and to really get a feel for what a prospective renter is going to feel like when they visit that property before and after you're done.
How does one realistically model out, the next 3 to 5 years, given, Florida, as well as a number of other states, but Florida has experienced double-digit rent growth. I mean, especially over the last year or two. And no one can answer the question, is that sustainable? Is it not sustainable? When's it going to stop? When's it going to slow? And so how does one, financially model out in a conservative manner the next couple of years while, not necessarily missing out on opportunity because you've completely underbid it and undershot, right, what the market value is today?
Yeah. So when we look at our upside, I try to break our upside into different components. We analyze the rent roll and try to assess risk to the upside. So the first is comparing what the seller's in place loss to lease is, right? Consider that the least risky because that's there. The seller's kind of proven it. Then we take a look at maybe a more risky bucket of upside would be, well, the sellers define their market, but we think the market as is a little bit higher. That's usually what we find. So those two buckets together are fairly low risk. And then we have the last bucket, which I wouldn't call it high risk, but it's the most risky of the three, is the value we are going to create with amenity improvements, unit improvements, and whatever it is that we're going to do. So I try to first assess the risk. And then secondly, what I do is I determine how much am I going to be able to get. I'll figure out how fast am I going to turn these units. Usually I don't budget less than 2 or 3 years to do this. In Florida, oftentimes we can do it quicker, but I want to be conservative and assuming I'm doing it over 2 or 3 years. And then what I don't do is project ridiculous organic rent growth. So we'll take each unit as it's renovated up to what we think is market at today's market, right, as improved. And then we'll move it maybe 2%, maybe 3% if we're really aggressive. And I think that's the responsible thing to do because you're right. I mean, Tampa, I think I saw some of the properties we take care of in Florida, we can't find the top. We just keep trying and we can't find the top. So that's ridiculous. That's not going to continue. But what I think will continue, and the reason I think you can get a little aggressive, is the demand supply setup that is going on and has gone on in Florida forever. It's just exaggerated now because of the low tax, high tax state. People are really recognizing that they're becoming more mobile. They can do their job. I mean, think about it. If you can do what you did in the Northeast, but you can do it in a sunny state with no taxes, at or near the beach. I mean, why wouldn't you, right? With a lower cost of living and still earn the same money you earned when you were in the Northeast. So, I just don't think that demand supply setup is going to change. And remember, I told you we do BC class assets, right? There's supply additions all over the place in Florida, but they're not adding BC stuff.
Yeah.
So think about this, right? You've got increasing demand that's not going to slow down, I think, anytime soon. You've got fixed supply. Your price has to go up. It has to continue to have upward pressure on it. So there you go. That's how we do it.
Yeah, no, I appreciate that. And just to clarify, and I didn't ask you this question before we started rolling here. As far as the management of the properties, you're completely vertically integrated, I believe.
We are. Yeah.
Okay. Got it.
Yep.
Pros and cons of that. I know you said you guys have approximately 2,000 units under ownership and management. Is it a benefit to be vertically integrated? Or are there some downsides as well? So maybe speak to both.
Yeah. So, well, the downsides of being vertically integrated is always, running a management company. It requires a lot of people, right? And people are just tough. Labor's tough to find. And, it's just running that business. But we think it's really important that we're vertically integrated because over the 23 years, 24 years we've been doing this, we've really hyper-focused on our operating processes, the way we do things, and we really feel like we've got some really solid best practices because, the best business plan is the best business plan, but if you're not going to be able to implement it, right? We trust ourselves to implement that. And our third-party managed clients also benefit from that. But let me tell you, the interesting thing, especially in a market like we're in right now, this vertical integration and the relationships that we have been able to generate with brokers is really, really valuable in this market. You think about it, right? Everybody's networked, right? Everybody says, they'll tell you, come on your show and say, we're networked, we're in our market, we're there every day. Well, we are as well, except the brokers will send us their clients to help make their deals successful. And when we do that, that creates a whole new relationship with that broker. So we're not only buying and selling through that broker, but we're standing alongside of them, helping them grow their business as a broker because they want the deal at the turn, because they've already done all the hard work. Now they just want to turn it again. So this partnership, that it's not a formal partnership, but what it's allowed us to do is generate relationships with brokers that it's really hard to generate, right? We get in a really good solid footing with them. And I think that helps us when it comes to getting first looks at deals and things like that.
Yeah, no, absolutely. I mean, you scratch my back, I'll scratch yours, right? It goes back to that old adage. So no, I love every bit of that. I never thought of it from that perspective though, of being vertically integrated, actually having, fee management on, for outside parties, and how that might tie back together to, forming these deep bonded broker relationships. But I love that. It makes a lot of sense. Florida, speaking of the many different markets that you're in, I mean, you're fairly across the board. Tampa Bay, Central Florida, and then up all the way up to Tallahassee. I think Jacksonville as well. Are you over in the Panhandle? Are you all the way over to Pensacola?
Not yet.
Okay,
not yet. No.
Okay. Well, my question is basically, of all the markets that you're currently in Florida, which are you the most bullish on, and why?
Yeah, so it's hard for me to find a market that I don't like in Florida. It just is, for lots of reasons, because what's happening is, as a market starts to get it more and more expensive, people, they just want to be in Florida. So they're happy to move and let the whole system grow together. I probably like and have liked Tampa the most. And the reason I do is because there's lots. I mean, Orlando, everybody's always said Orlando's been the price leader, right? And I think historically that's been true. Then Tampa is usually next. But what Tampa has is just some really interesting water. If you love water and you love the Gulf and you love beaches, I mean, it's hard to not like Tampa and that whole surrounding area. It's really hard. And so when you're in our business, one of the things that we like when we're doing value add is to have some barriers, right? Have a reason for someone to want to live there, and to make it more difficult for them to just sprawl out everywhere, right? So if they want to live in St. Pete or Clearwater, I mean, they're going water on one side, water on the other, right? They can go south, but they're going to run into water. They can go north, and they can go north, and they do, and that is happening. But the point is that you have more barriers to that entry. So I just love Tampa. It's just a very, very cool place. Yeah. I've always thought that for at least the last 15 years, and I think it's proven to be true.
Absolutely. No, I love every bit of it. Unfortunately, the secret is out, which is good from a business side, but from a personal side, the additional traffic becomes a little challenging sometimes. But anyway, now that's just me being an old guy bitching and moaning, right?
Well, I deal with that traffic every time too. Yeah, I-4 is nothing short of
God,
a challenge.
I stay away from I-4. Oh God, that is the highway that I will do anything to avoid. In any event, I want to talk about buying existing product versus ground up development. It seems as though, based on our conversation and looking at your existing portfolio, you're buying, B and C, legacy type products.
Mm-hmm.
Have you considered ground up development? And at this point, why haven't you gone that route with some of these future investments?
Yeah, that's a good question. We just haven't done it yet. It's not something I've done.
Mm-hmm.
And when we get into it, we probably will get into it at some point, but I'll do it with my own money first. Yeah. It's really important to me that I'm not learning on our investors' dime. I'm sure they would appreciate that. So I'll do it. I'll probably do it on a small scale a couple times myself. It's the one thing that I haven't done yet that I do want to do. I think it makes a lot of sense. But what we try to do is get really good at something and stick with it. Right? Especially in a market like we're in right now. It's a tight market, right? You've got to understand your business. You got to understand how you're going to make money. And, it seems like it might be a tough time to go out and try something brand new in a hot market like that.
Mm-hmm. No, absolutely. Um, I want to speak to your own personal funds. Outside of your own investments, the multifamily projects that we're speaking to today. Is there any other type of real estate that you're deploying your own personal funds into? And if so, what are they?
Yeah, it's not. It's all multifamily.
Okay.
If I were to do that, I care more about diversified income streams
Mm-hmm.
and an asset type that is difficult to replace, right? It's not going to be subjected to significant economic downturn. For example, I'm not a huge fan of retail because I don't know. I just feel like there's so many things that can impact the demand for that retail space. Now, I know guys do really well. Lots of guys do really well with it. It's just not something we know. I like multifamily because I can't figure out a way to make it so that people don't need a place to live. I can find a way to not need a retail store. I can find a way to not need self-storage. I can find a way to not need some of these other things, but a home, I can't figure that out, right? And that's a good thing because that means the demand for my product is hopefully a little safer.
Yeah, no, I like that. That's a good answer. That's a good answer. Fair enough. Well, I appreciate you sharing that and being open about answering that question. Everyone speaks about the best deals they've done, the ones that are just home runs, they hit it out of the park, double-digit returns, exceeded expectations. Very few people ever talk about the ones, again, we talked about the ones that hadn't met expectations, but really digging a little even deeper, there's always that one or two deals that just speaking to this, that I can think of that gave me additional gray hairs. It gave me added stress. They really met that 80-20 rule where they literally took 80% of our resources, our time and energy and effort, and you could not wait to cut them loose. So when I say that, what deal or deals come to mind? And, maybe if you could share some, particulars as to what were they, what went wrong, what would you have done differently looking back, and so on and so forth.
Yeah. Yeah. So I know your previous guest called those turds. I would call it a dog. One deal comes to mind. And by the way, our entire track record, I don't know if you've ever heard of veravest.com. If you haven't, think about it. It's they fully vet sponsors like us. But the point is our full track record's out there. And you'll see a deal that we did in Cleveland Heights a long time ago, suburb of Cleveland. And, we bought it. I don't think it was very early on in my career. And I don't think I fully understood the business plan, right? I felt like I had other assets in the area. I felt like I was going to get economies of scale. And I didn't think of the business plan in the same respect that I think now of our business plan, right? We know exactly what we're going to do, how we're going to make money, and how, if something's going to derail us, what it might be. So what happened is exactly what you described. Cleveland, it was post-recession. Cleveland just never really recovered previous to the 08-09. I'm talking about the 08-09 recession. It just never really recovered. The demand never recovered in that neighborhood. And so I had a choice. I said, okay, we can sell this thing now. And, we would consider it a dog. We didn't lose tons of money or anything like that. But I could continue to spend 80% of my time on it and really not get anything for it. Or I can just say, you know what, let's cut the cord here and move on and spend my time on profitable things. So it was that deal. It is in Cleveland Heights, and it's there for everybody to see in our track record. I mean, we certainly didn't lose a bunch of money or anything like that, but it taught me a lot. And the lesson it taught me was to make certain you understand your business plan going in. When I hear people say, yeah, I bought it because I have other properties in the neighborhood, I cringe because I did that once. And I didn't understand how I was going to make money on that deal, right? I just thought it would magically happen because I owned all these other properties in the neighborhood, and didn't turn out that way.
Got it. And I guess another variation of that question would be of a deal that you might have walked away from, a deal that you liked it from the outside looking in, you guys did some initial underwriting on it, you got it tied up under contract, and during your due diligence, something or another came up that you weren't able to work your way through with the seller, or maybe it just scared you away entirely. Are there any deals like that come to mind that you could share with us as to what were the reasons or reason, whether it's singular or plural, as to why you've decided to not move forward and close on that deal?
Yeah, so it's pretty rare. First of all, we never retrade. We just don't do that, right? In our market, you only have to do that once, and you're not going to get the call from the broker. Yeah. We did back out of one deal, and it was because the And to the seller's credit, I'm not going to share which one at this point, but to the seller's credit, they disclosed correctly that there were sinkholes on the property and that they thought that they had dealt with them appropriately. And after diving into the engineering reports and so on and so forth, I just couldn't get comfortable that I could mitigate that risk to the level that I was comfortable. So we backed out of that deal. That was the only, I mean, that was I don't even know if we ended up sending in our earnest money on it because, the seller, to again, to their credit, they full disclosure, here's the deal. We want to make sure you understand it going in so that, there's no problems later. And we just decided to back out of that. But that's probably and I don't think anybody would blame anybody for backing out of that deal. And as it turns out, there were more sinkholes on the property than,
oh boy.
And it's terrible. It happens sometimes, but when you find a risk like that, you want to walk away from it.
Yeah, it's Florida. I mean, I guess you build on sand, inevitably that's going to happen here and there.
It is. It is. Yep.
Ken, what advice would you give to new investors that are looking to, build their foundation and get involved in multifamily investments? I mean, some general high level advice, if you can go back to yourself 20, 24 years ago and give yourself some advice, what would it be?
Yeah, it would be a couple of things. First of all, get a mentor. I did that on my first deal. I paid an attorney $3,000, just help me with the legal work, but to really make sure, give me the blessing on this deal. I'm not going to lose my rear end on it. He had owned thousands of units. So no, get a mentor. That's one thing. And the second thing is do the homework. Now, being in third-party management, we talk to a lot of people trying to get into Florida. And the number one theme that I hear from people is they don't want to dive in. Remember, I said, I build my own rent stack. I Google Drive these properties. Then I get out of my car and I look at them and just really get a good understanding. I always tell people knowledge builds confidence, right? So in this business, go through the process of understanding the P&L, do the work that's necessary. In our business, we can prove out every single number on that P&L except maintenance and repair because we just don't know when something's going to break. Take the time to do that homework because when you do, then you're not relying on someone else, not really giving you an honest opinion about whether it's going to be okay, but because you've proven out all the numbers. So take the time, do that work. And when people do that, they generally do very well because they're very confident and they're very comfortable that they're doing the right thing.
No, I love that. And one of the things that popped in my mind I meant to ask you earlier on was, it seems as though you guys have somewhat drawn a invisible line in Florida. I guess really probably Tampa Bay is probably the base of that line, and everything that you've invested in has been Tampa Bay and then north. Is there a particular reason why you haven't explored, really, I'm speaking to South Florida, so Fort Lauderdale, Miami, West Palm, and that area over there, or is that on the radar at some point in time?
It's on the radar. We just haven't gotten there yet.
Got it.
Yeah, I tend to be conservative and I want to go to a market, understand it, own there, manage there, then I move on. So yeah, it's on the radar.
All right, sounds good. Well, Ken, it's been a pleasure having you on the show. I really appreciate you coming on and sharing all your insights and knowledge and wisdom with us. It's been a lot of fun having you here, my friend.
Well, thanks so much for having me. I appreciate it.
All righty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.